Hello everyone, welcome to Finance by Avisha and Arpita. In today's video, we'll learn the financial ratio analysis. So, coming to the note on financial ratios, over the last few videos, we have understood how to read financial statement. We will focus our attention on analyzing three financial statements. The best way to analyze a financial statement is by studying the financial ratios. The theory of financial ratios was most popular by Benjamin Graham, who is popularly known as the fundamental analysis father. The financial ratios help interpret the result and compare with previous years and other companies in the same industry. A typical financial ratio utilizes data from financial statement to compute its value. Before we start understanding the financial ratios, we need to be aware of certain financial ratios attribute. On its own merit, the financial ratio of a company conveys very little information. For instance, assume Ultratech Cement Limited has a profit margin of 15%. How useful do you think this information is? Well, not much really. 15% profit margin is good, but how would I know if it is the best? However, assume your figures out ACC cement profit margin is 12%. Now, as we are comparing two similar companies, comparing the profitability makes sense. Clearly, Ultra Cement Limited seems to be a more profitable company between the two. I'm trying to drive across that more often not financial ratio on its own is quite mute. The ratio makes sense only when you compare the ratio with another companies or a similar size of when we look into the financial ratio trend. This means that once the ratio is computed, the ratio must be analyzed either by comparing or tracking the ratio historical trend to get the best possible interference. Also, here is something that you need to be aware of while computing ratios. Accounting principles may vary across companies and different financial years. A fundamental analyst should be cognizant of this fact and adjust the data accordingly before computing the financial ratios. So, coming to financial ratios, there are four types of financial ratios: profitability ratio, leverage ratio, valuation ratio, and operating ratio. So, what is profitability ratio? Profitability ratio helps the analyst measure the profitability of the company. The ratio convey how well the company can perform in terms of generating profit. The profitability of a company also signals the competitiveness of the management, as the profits are needed for business expansion and to provide dividend to its shareholders. A company's profitability is an important consideration. Now, coming to the leverage ratio. Leverage ratio refers to solvency ratio or gearing ratio, measures the company's ability in the long term to sustain its day-to-day operations. Leverage ratio measures the extent to which the company uses the debt to finance growth. Remember, for the company to sustain its operation, it has to pay its bills and obligation. Solvency ratio helps us understand the company's long-term sustainability, keep its obligation in perspective. Now, coming to the valuation ratio compares the company's stock price with either the profitability of the company or the company's overall value to get a sense of how cheap or how expensive the stock is trading. Thus, this ratio helps us analyze whether the company's share price is perceived as high or low. In simple words, the valuation ratio compares the cost of security with the perks of owning the stock. Now, coming to the operating ratio. Operating ratio is also called the activity ratio, measuring the efficiency at which the business can convert its asset, both current and non-current, into revenue. This ratio helps us understand how efficient the management of the company is. For this reason, operating profits are sometimes called the management ratio. Strictly speaking, ratios, irrespective of the category it belongs to, convey a certain message, usually relate to company's financial position. For example, profitability ratio can convey the company's efficiency with which it measures or computes the operating ratio. Because of such overlaps, it's difficult to clarify these ratio. Hence, this ratio are sometimes somewhat loosely classified. Now, diving more deep into the profitability ratio, um, we will look into ratio. So, profitability ratio has these elements: EBIT margin, PAT, return on equity, return on asset, return on capital employed. So, what is Ebi Tda margin? So this is earning before interest, tax, depreciation and amortization margin. So it indicates efficiency of the management. It tells us how efficient the company's operating model is. EBIT margin tells us how profitable the company is at an operating level. It always makes sense to compare the company's EBIT margin versus its competitor to get a sense of the management efficiency in terms of managing their expense. To calculate Ebi Tda margin, we need to calculate. So for this, it is Ebi Tda is equal to operating revenue minus operating expense. And operating revenue is total revenue minus other income, and operating expense is total expense minus finance cost minus depreciation minus amortization. And EBIT margin is EBIT margin is EBIT. This is EBIT and we divide it by total revenue minus other income. Continuing the example of Amara Raj Battery Limited, the EBITDA margin calculation for the year 2014 is, we will calculate EBIT, which is computed as total revenue. This total revenue minus other expense, and we subtract from this is expanded as total revenue minus other income, and other expense is calculated as total expense minus finance cost minus depreciation minus amortization, right? Other income is income under investment and other operating activity. Including other income in EBIT calculation would clearly skew the data. For this reason, we will exclude other income from total revenue. So, I have two questions for you at this stage. What do an EBIT for 560 crores, that is the EBIT for Amara Raj Limited company, 560 crore indicate, and an EBIT margin of 16.3% indicate? How bad or good an EBIT margin at 16.3% is? The first question is fairly simple. An EBIT of rupees 560 means the company has retained rupees 560 crores from its operating revenue of rupees 360 crores. This means out of 36 crores, the company spent 2876 crores towards its expense. In percentage term, the company spent 83.7% of its revenue towards the expense and retained 16.3% of the revenue at the operating level for its operations. Now, the second question, hopefully, you should not have an answer. Remember, we did discuss this point earlier in this video. A financial ratio on its own convey very little information. To make sense of it, we should either see the trend or compare it with its peers. Going with this, a 16.3% EBIT margin conveys very little information. To make some sense of the EBIT margin, let us look at Amara Limited EBIT margin. That is, you can look at this picture. So you can see EBIT margin trend for the last 4 years. All numbers in rupees crores except EBIT margin. It appears that ARBL has maintained its EBIT at an average of 15%, and in fact, a closer look at it is clear that EBIT margin is increasing. This is good sign as it shows consistency and efficiency of the management operational capabilities. In 2011, the EBIT was rupees 257 crores, and in 2014, EBITDA is 560 crores. This translates to a 4-year EBITDA growth rate of 21%. Please note, we have discussed the formula for CAGR in module in earlier videos. Clearly, it appears that both EBIT margin and EBIT growth are quite impressive. However, we still do not know if it's the best. To find out if this is the best one, you need to compare these numbers with its competitors. In case of ARBL, it would be exceed Battery Limited. I would encourage you to do the same for exceed and compare the results. Now coming to the second, PAT margin. So the PAT is explicitly stated in annual statement. ARBL PAT for the year 2014 is rupees 367 crores on the overall revenue of rupees 3482 crores, including other income. This translates to a PAT margin of 367 by 3482, 10.5%. Here is the PAT and the PAT margin trend of for ARBL. The PAT and the PAT margin trend seems impressive as we can clearly see a margin expansion. The 4-year CAGR growth stand at rupees 25.48%, which is again good. Needless to say, it always makes sense to compare ratios with its competitor. Return on equity is a critical ratio as it helps the investor access the return the shareholder earns for every unit of capital invested. ROE measures the entity capability to generate profit from the shareholders' investment. In other words, ROE shows the efficiency of the company in terms of generating profit for its shareholders. Obviously, the higher the ROE, the better it is for the shareholders. In fact, this is one of the key ratios that helps the investor identify investor attribute of the company. The average ROE for top high companies varies between 14 to 16%. To give you a perspective, I personally prefer to invest in companies that have an ROE of 18% onwards. This ratio is compared with other companies in the same industry and is observed over time. Also note, if the ROE is high, good amount of cash is being generated by the company. Hence, the need for external funds is less. Does a higher ROE indicates higher level of management performance. ROE is calculated as net profit by shareholders' equity and we multiply it with 100. There is no doubt that ROE is an important ratio to calculate, but like any other financial ratio, it also has a few drawbacks. To help us understand its drawback, consider this hypothetical example. Assume Vishal runs a pizza store. To bake pizza, Vishal needs an oven which costs rupees 10,000. The oven is an asset to Vishal's business. He procures the oven from his own funds and seeks no external debt. You would agree on his balance sheet that he has a shareholder equity of rupees 10,000 and an asset equivalent to rupees 10,000. Now assume in his first year of operation Vishal generates a profit of rupees 2,500. What is the ROE? This is quite simple to compute. ROE is 2,500 and we divide it by 10,000. That comes out to be 25%. Now let us twist this story a bit. Vishal has only 8,000. He borrows rupees 2,000 from his father to purchase an oven worth rupees 10,000. How do you think the balance sheet would look? On the liability side, he would have shareholder equity of rupees 8,000, debt of rupees 2,000. This makes Vishal total liability of rupees 10,000. Balancing this on the asset side, he has an asset worth rupees 10,000. Let us see how the ROE looks now. It is 31.25%, that is 2,500 divided by 8,000 and we multiply it by 100. With an additional debt, the ROE shoot up quite significantly. Now, what if Vishal had only rupees 5,000 and borrowed the additional 5,000 from his father to buy the oven? His balance sheet would look like shareholder is 5,000, debt is 5,000. So 2,500 divided by 5,000, ROE comes out to be 50%. Clearly, higher the debt Vishal seeks to finance his asset, which in turn is required to generate profit, higher is the ROE. A high ROE is great, but certainly not at the cost of high debt. The problem is what with an high amount of debt, running the business get very risky as the finance cost increase drastically. For this reason, inspecting the ROE closely becomes extremely important. One need to do this by implementing a technique called the Dow Pound model, called the Dow Pound Identity. This model was developed in 1920s by Dow Pound Corporation. Dow Pound breaks up the ROE formula into three components representing a certain aspect of the business. The Dow Pound analysis uses both the P&L statement and the balance sheet for the computation. The ROE, as per the Dow Pound, can be calculated as return on equity, net profits divided by net sales. We multiply net sales and divide by average total asset and multiply average total asset with and divided by shareholder equity. If you notice this formula, the denominator and the numerator cancel with one another, eventually leaving us with the original ROE formula, that is net sales, and we divide by shareholder equity and multiply with 100. However, in decomposing the ROE formula, we gain insight into three distinct aspects of the business. Let us look into these components of Dow Pound model that makes up the ROE formula. Net profit margin. Net profit margin is net profit divided by net sales into 100. This is first part of the Dow Pound model, right? And it expresses the company's ability to generate profit. This is nothing but the PAT margin we look at in the earlier video. A low net profit margin would indicate higher cost and increased competition. And now coming to asset turnover is equal to net sales, and we divide by average total asset. Asset turnover ratio is an efficiency ratio that indicate how effectively the company is using its asset to generate revenue. Higher the ratio, it means the company is using its assets more efficiently. Lower the ratio, it would indicate management or the production problem. The resulting figure is expressed as several times per year. So now finance leverage is equal to average total asset, and we divide by shareholder equity. Financial leverage helps us answer this question. For every unit of shareholder equity, how many units of asset does the company have? For example, if the financial leverage is rupees 4 for rupees 1 of equity, the company support rupees 4 worth of asset. Higher the financial leverage along with the increased amount of debt will indicate the company is highly leveraged. Hence, the investor would exercise caution. The resulting figure is expressed as several times per year. As you can see, Dow Pound model breaks down the ROE formula into three distinct components, with each component giving an insight into the company's operating and financial capabilities. Let us now proceed to implement the Dow Pound model to calculate Amara Raj ROE for the year 2014. For this, we need to calculate the value of the individual component, net profit margin. So as I mentioned earlier, this is same as the PAT margin. From our calculation earlier, we know the net profit margin is 9.2% for Amara Raj Battery Limited. Now asset turnover is basically net sales, and we divide it by asset turnover net profit divided by net sales into 100. This is the first part of the Dow Pound model, and it expresses the company's ability to generate profit. This is nothing but the PAT model we looked in the earlier video. Now coming to asset turnover model, as I said, is an efficient ratio that indicate how efficiently the company is using its assets to generate revenue. Higher the ratio, it means the company is using its asset more efficiently. Lower the ratio, it would indicate management or the production problem. The resulting figure is expressed in several times per year. Now, what is financial leverage? Financial leverage is average total asset, and we divide by shareholders equity. Financial leverage helps us answer this question. For every unit of shareholder equity, how many unit of asset does the company has? For example, if the financial leverage is 4, for every 1 of equity, the company support rupees 1 along with it. Now coming to net profit margin. that is net profit margin is same as PAT margin. Now coming to asset turnover ratio that we mentioned here. Now let's come to ROE. What is ROE? ROE is net profit margin multiplied with asset turnover into financial leverage. That is 9.2% into 1.75% into 1.61%. That comes out to be 25.9%. I understand this is lengthy way to calculate ROE, but this is perhaps the best way to calculate ROE. We can develop valuable insights into the business. Dow Pound model not only answer what the revenue is, but also the quality of the return. However, if you wish to do a quick ROE valuation, you can do so by the following way. ROE is net profit into net profit by average shareholders equity. That comes out to be 30.31%. Now coming to the ROA. What is ROA? Having understood the Dow Pound model, understanding the next two ratios would be simple. ROA evaluates the effectiveness of the entity's ability to use the asset to create profit. A well managed equity limit investment in now effective productive asset. Hence ROA indicates the management efficiency at deploying its asset. Needless to say, the higher the ROA, the better it is. ROA is net income plus interest. We multiply it with 1 minus tax rate and divide by total asset, average asset. From the annual report, we know net income for the year is 367.4 crores. So what does interest into 1 minus tax means? Well, think about it. The loan taken by the company is also used to finance the asset, which in turn is used to generate profit. So in this sense, the debt holders entity are also the part of the company. From this perspective, the interest paid also belongs to the shareholder of the company. The company also benefit in terms of paying lesser taxes when interest is paid off. This is called the tax shield. For this reason, we need to add interest by accounting for tax shield while calculating the ROE. So now let's move to the other ratio, ROCE. So ROC indicates the company's profitability taken into consideration the overall capital employed. ROCE is profit before interest and tax and divided by overall capital employed. So this and overall capital employed is short. So this is short term debt plus long term debt plus equity, and this was 37.18%. So the key takeaways from this video are: a financial ratio is uh, used to see a financial metrics of a company on its own merit. The company conveys very little information. It is best to study the financial recent trend or compare it with the company's peer to develop an opinion. A financial ratio can be categorized into profitability, leverage, valuation, and operating ratio. Each of these categories gives the analyst a certain view of company's business. EBIT is the amount of money the company makes after subtracting the operating expense of the company from its operating revenue. EBIT margin indicates percentage profitability of the company at operating level. PAT margin gives the overall profitability of the firm. ROE is a precious ratio. It indicates how much return the company shareholders are making over its initial investment of the company. A high ROE and high debt is not a great sign. Dow Pound model helps in decomposing the ROE in different part, with each part throwing little on different aspect of the business. Dow Pound model is probably the best way to calculate the ROE of a firm. Return on asset is an indicator of how efficient the company is utilizing its asset. Return on capital employed indicates the overall return of the company generating considering both the equity and debt. For the ratio to be useful, it should be analyzed comparing with other companies in the same industry. Also, ratio should be analyzed both at a simple point in time and as an indicator of broader trend over time. So this is all about the financial ratio analysis. Thanks for watching. Thanks for watching. Please subscribe to the channel and hit that like button if you like the video. Bye bye and subscribe.